Alrighty guys, so in today's episode, we're going to be starting a series. This is going to be turning $0 into over $100,000 in my stock market portfolio. So I hope you guys enjoy it, and if you guys get anything in value, hit that like button because it really helps me out. If you have any questions, ask them down below. Also, check out my course. It's $5. We talk about how to properly invest in the stock market. It's definitely worth it. We talk about fundamental analysis, technical analysis, taxes, retirement, everything you need for investing in the market. So at least check it out. So now, to jump into it, roll the intro. Let's go. Bam! So like I said before, I am starting a series. I'm going to be building a stock market portfolio with a dividend yield of around 3% or so and a total value of $100,000. This is going to bring my passive income to right around $3,000 per year or around $250 a month, which is pretty good. You know, that could be a car payment, that could be some insurance, that could be pretty much anything you could use it for, but realistically, I'm just going to automatically reinvest it right back into my account. You know, and I completely understand this could take me a year, 2 years, or even 3 years, but I'm going to be very consistent with my investments. I'm going to be investing right around $1,000 to $2,000 per month into this account. So what broker am I going to be using? Well, I'm going to be using M1 Finance. The reason why I like them, and I'm not getting paid or sponsored by them at all, but I just like how simple they make investing. They have what you call pie investing. So it's an easier way to diversify your money instead of picking and choosing, okay, I want to invest 10% in Apple and do the math in your head. M1 Finance does it all for you. It's called pie investing. It's really cool. There's no fees, no commission, so I don't have to worry about anything like that. So now, what are going to be my investments in this account? So starting off with my largest investment of 40% of my money, or $40,000, this is going to be going into ticker symbol SPY. The reason why I like this one so much is because this gets an average return of around 10% per year. Not to mention, you get a solid dividend. So you're gonna be getting some cash flow, your money's gonna be growing, and on top of that, you don't have to check the day-to-day price. When I invest into the S&P 500, it's pretty much like investing in the US economy. You're investing in the top 500 companies on the market. So you're gonna be getting diversification, you're not gonna have any nasty fees, it's just a great investment for the long term. So starting off with my second investment, this is going to be in Vanguard's High Dividend Appreciation ETF, ticker symbol VIG. The reason why I like this one is because they pick and choose high quality dividend paying stocks. It has a return rate of around 9%, so not as good as the S&P 500, but you're going to be getting paid better dividends. So this is where I'm going to boost my cash flow from. So really, I'm going to be investing 10% of my money into this ETF, which is really good. So my third investment is going to be in ticker symbol BND. Now this is the total bond market, and I completely get it. You guys are like, Carter, why are you investing in bonds? I hear it every single video, but let me just explain something. When you invest in the bond market, you get a dividend yield of around 3.5%. So you're going to be getting cash flow coming in. Not to mention, bonds have an average return of around 5%. And let me tell you something. That's better than a savings account and better than pretty much a lot of stocks, to be honest, out there. Not to mention, what I do is a little different than traditional bond holders. What I do, once the market falls, I sell my bonds and take the money and put it into the S&P 500 because I know the S&P 500 can give me a greater return on my money, and as the stock market starts going up in value, that's when I start putting more money into the bond market. And bonds don't move as much, so it's kind of like a defense in my portfolio. It's really good, and I highly recommend you guys at least check out the bonds. So then I'm going to be investing 5% in ticker symbol QQQ. This is pretty much like a lot of tech. It's a tech heavy ETF. So this gets a greater return on my money. It is a little more volatile. That's why I'm only investing 5% in it. I'm hoping this to get around 15 to 16% yearly. That's going to definitely boost up a lot of my portfolio. And with another 5% investment, this is going to be going into Home Depot. Home Depot has outperformed all of the major indexes, and you get a fantastic dividend. So it's just like a no-brainer investment. I know that this stock and company can continue to grow. Not to mention, it's rated one of the best places to work, so they have happy employees, which they make a lot of money. So my next investment coming in at 4% is Costco. Now Costco is rated one of the best places to work, and the stock has outperformed all the major indexes, which is really good, because when I say that, I hope history repeats itself. The fundamentals on Costco looks really promising. It pays a dividend, and it sometimes pays a special dividend. Like it did, I believe, in 2011, it paid $7 per share. So if it does this, you're hoping it could be maybe $10 per share. That would be really, really strong. And I can take that and reinvest it right back into Costco. Now, 3% coming in at Apple. And I know a lot of you right now are saying, Carter, why are you only investing 3% in Apple? Apple is one of the largest companies out there. Well, the reason why I'm investing only 3% is because I'm hoping that 3% can move a lot more than a stock could be at 5%. And you get paid not as much in dividends compared to other stocks. But Apple is a very, very strong company, and that's why it is in my portfolio. Now, coming in at 2% is Disney. Disney did cut their dividend, and I'm hoping they can re-announce that and the stock could continue to grow in value. Disney is a media powerhouse, and really, I don't have to worry about it for the next 5 to 10 years. 2% coming in at Microsoft. Microsoft is a very, very strong company, especially in the short term. They're announcing their new Xbox, and I can guarantee they're gonna beat revenue growth and beat deliveries on all of their Xboxes and a lot of their tech-heavy product. Now, 2% is coming in with Google. Google has outperformed all the major indexes, but it is a little more risky stock. It has grown in value over the course of the long term, so I don't have to worry about it in that sense, but that's only 2%, doesn't pay a dividend, so that kind of sucks too. Now, coming in at 2% is Visa. Visa has definitely outperformed all of the major indexes, and the thing that I don't like about Visa is they don't pay as strong in dividends. They did just do a dividend increase, which is really, really good for investors. But this is a very, very strong company, and I think this over the course of the long term, in the next 10, 15 years, this company is gonna grow in value. So now these are gonna be all my 1% investments. So all of these, I'm only investing 1% of my portfolio in it. So starting off with number 1, we have Johnson & Johnson. Number 2 is Walmart. Then we have Cisco, then we have PepsiCo, then we have a lot of these other ones, MasterCard, McDonald's, AT&T, Lowe's, Coca-Cola, Tesla, Nvidia, Facebook, and JP Morgan Chase. So that is it. I hope you guys are excited for this challenge like I am, and if you are, make sure you guys hit that like button because it will really, really help me out. So we'll see you guys tomorrow in another episode. Remember to stay happy, stay positive, and especially right now, guys, stay safe out there. We'll see you tomorrow, guys. Take care.